If you think cryptocurrencies are a scam or fraud or surreal or too good to be true, then think again. The world had been extensively manipulated by the financial system to an extent that we rarely question banks to be a scam. Have you ever thought that your mistrust in the financial system would bring a major meltdown of fiat currencies into your experience? A major reform of financial system is in the process. You may or may not like to believe or agree, but you're entering into crypto economy, and as I always say, or write or tweet, change will happen with or without you. And that's why in this video, I'm going to be discussing would COVID-19 recession influence investors to put their money into Bitcoin and cryptocurrencies. But before we get into that, hit that thumbs up below so that YouTube share this video with everyone else. Subscribe to MONET YouTube channel, that way you don't miss our new cryptocurrency education videos every single week, and hit that little notification bell too so that YouTube lets you know when a new video is released. Hi, hope you all are doing well. I am Afshin Jaffrey and welcome to MONET Blockchain and AI channel. Every recession in recent history has been caused by a specific trigger. The past three bubbles were all unprecedented. First was the deregulation of consumer finance in 1990. The next was the rise of the internet in 2001, fostered by concerns over Y2K that kept the bubble going for a while longer as businesses continued buying in equipment and programming with FOMO of keeping their systems from crashing by the turn of the century. The bubble in tech stocks bursting, and as a result, trillions of dollars of equity wealth were erased. The last and the very recent that most of us witnessed, but hopefully not experienced, back in 2007 to 2008 was the housing bubble, worst of all three. A global savings glut allowed an unprecedented volume of capital to flow into the US real estate market. When the bubble collapsed in 2008, the financial crisis affected the entire globe. Markets failed to fully price in their risks, setting the stage for sudden downturns when the bubbles began to deflate. Now at present, COVID-19 pandemic has led to yet another unprecedented economic crisis, with the IMF calling it the worst recession since the Great Depression that world experienced from August 1929 to March 1933. So why is it estimated to be called Great Depression? Companies are missing their earnings estimates, and many traditional investments have taken a hit across the board. The crisis has investors scrambling to find safe haven assets, and more people are now really interested to know whether cryptocurrencies such as Bitcoin are a good investment. So today I'm sharing my 3 reasons why I see considerable demand from institutional investors for cryptocurrencies post this pandemic. There's a very good chance that the stock market may lose its attractiveness after the coronavirus crisis due to decreased demand for many companies' products due to consumers' reduced purchase power, resulting in long-term declines in the corporate profits. Most consensus is that a V-shaped recovery of stock price is difficult and or sustainable, but I could be possibly wrong talking long term. Therefore, investors need to seek out investment options other than stocks, because if you are an investor, you know you can't just put everything in cash. Let's see what's really happening with stock markets over the past few months. The stock market has responded to the COVID-19 pandemic with worrying volatility because traders have panic sold out of fear. As a result of the recent turmoil, the market-wide circuit breakers that attempt to prevent panic trading have been triggered 4 times along in March. That's right, 4 times. Wait, what's market-wide circuit breakers anyway? The US Securities and Exchange Commission mandated the creation of market-wide circuit breakers to prevent a repeat of the October 19, 1987 market crash in which the Dow plunged 22.6%. Since then, they have only occurred once in 1997 before the 4 times this March. The purpose of breakers are to calm markets by halting trading as it grows more and more volatile, which means that a 15-minute pause is imposed in trading on all US stock exchanges if the S&P 500 index falls more than 7% before 3:25 p.m. New York time. So we can surely say that the stock market is experiencing some of its highest drops ever as a result of COVID-19. Now let's see how stock market is losing its attractiveness to the investors. The coronavirus outbreak is leading investors to plan for situations more serious than a recession. B, the S&P 500 has declined by 29.5% in 2 months, although experts anticipate the equity gauge to rise further towards 3,000 by the year end. It also expects a near 20% decline to around 2,400 in the 3 months to come. Number 3, the Federal Reserve's action to cut interest rates has been perceived as a total breakdown of confidence. Number 4, the coronavirus shockwaves rippling through stocks are forcing investors to contemplate outcomes more extreme than recession, including several quarters of declining economic activity, a credit crisis, or even an economic depression. Now, let's loosely define economic depression here: a combination of a prolonged slump of activity that lasts longer than just a few quarters, a very significant rise in unemployment, and mass business bankruptcies and bank failures. The rising global toll from the pandemic and the uncertainty over how far it may spread has left investors and economists scrambling to gauge the financial fallout that would bring Bitcoin to their attention, surely. Which also takes us to our second reason that pushes cryptocurrencies towards investors' attention. There is still a very little correlation between cryptocurrencies and traditional investments, or if I dare to say, Bitcoin is a non-correlated asset, meaning as stocks go up or down, Bitcoin doesn't seem to be bothered. Really? Let's see then. During the market plunge before the global lockdown, of course, all assets were sold, even gold and bitcoins were sold, but they picked up pretty quick, creating a bigger room to incorporate assets that will have little correlation with the uncertainty of the times we are entering into. Obviously, the difference in the nature of the both is that is traditional assets and cryptocurrencies explains such an insignificant correlation. The entire infrastructure of cryptocurrencies is self-reliant. For example, the systems, nodes, technology, and merchants, etc., do not rely on any external factors. The price of a Bitcoin theoretically is not tied to economic indicators of the real sector. It is a separate closed market in itself. The only thing that is similar is the law of supply, demand, and obviously all its derivatives. A subtle link between the two worlds is the trading tool BTC/USD. Its self-sufficient nature on the one hand indicates that the cryptocurrency market is moving more or less independently, but on the other hand, it continues to be the subject of manipulation by speculators. Let me tell you something really interesting. The top 10% wealthiest households own 84% of the available US stocks, and those 10% wealthiest households are almost none other than baby boomers, holding almost no Bitcoin. Millennials, on the other hand, who own Bitcoin, have a small allocation to stocks. So, in theory, Bitcoin seems more immune to liquidation and margin calls, confirming my theory of Bitcoin as a non-correlated asset moving in tandem with gold and has swung inversely to moves in the stock market. As Bitcoin continues to age, gaining further recognition with time, the asset may develop a more predictable correlation or lack of correlation to traditional markets or world events. At this point, however, the king of cryptos, Bitcoin, appears to be finding its way one step at a time, changing its correlation at times. Now on to our last and the third reason. The third reason why investors will be more interested in cryptocurrencies compared to other asset types is that among such uncorrelated assets, the one most investors have not yet incorporated into their portfolios is cryptocurrency, especially the very famous and equally controversial Bitcoin. Regarding the level of interest for cryptocurrencies, a cryptocurrency investment fund management company reports inflows totaling $503.7 million into cryptocurrency investment products. This is the largest scale ever. What's even more interesting to know is that the 88% of all investments made were by institutional investors. It is good news that investors' interest in virtual currencies has not declined, which means that interest from institutional investors is expected to grow after the coronavirus crisis. Traditionally, investors would protect their cash against this type of inflation by turning their cash into gold. But now there's a new digital gold on the block called cryptocurrency. Not to forget, with a global recession looming, purchasing power of traditional currencies is bound to be impacted. So what else could stir investors' interest in Bitcoin and cryptocurrencies as a non-correlated asset? The BTC halving in May remains a solid argument against a crypto crash. Currently, one can make a profit mining cryptocurrencies even in countries with cheap electricity at a price of at least 4,000 USD. At the time of recording this video, almost 24 hours had passed since the much anticipated Bitcoin halving happened. The block reward and the emission is halved, and the bar for profitable mining rises to 6,000 to 7,000 US dollars. Below this price, there is going to be a serious deficit of sellers on the market. This would most likely mean that the market price of BTC is going to be no less than 8,000 USD. I could possibly be wrong though. Let's get greedy and find more reasons to see Bitcoin as a non-correlated asset attracting investors. Money or fiat, in my opinion, will be deemed contaminated, resulting in digital dollars from all the countries. Once that occurs, it would be up to you to trust BTC or governments. COVID will be the tipping point for the shift to digital currencies. The fact that Bitcoin is currently up for this year is pretty impressive, considering that very few asset classes can say that right now. The positive that I draw from this pandemic is that people have started questioning and doubting monetary policy. So what if it took printing trillions of dollars for us to pay attention? But at least most of us are learning the difference between soft and hard money, and why a fixed supply currency just like Bitcoin, which is only 21 million, in case you may not know, is a smart substitute to fiat. Either the media are drumming up another recession, or it's slowly starting to happen. Concluding this video, I firmly believe that the cryptocurrency could become one of the world's biggest asset classes in just a matter of few months. The good news is that in the midst of a chaos, there's always also an opportunity. Thank you for watching. If you enjoyed this video, share it with one friend, helping me spread the word. Thank you for watching, and as always, keep singing cryptos.